Welcome to Alpha Insights. I'm Jeff. Today we unpack the latest inflation read and how the AI investment boom is starting to change the macro picture. With me is Jessica. Great to have you here. Remember, if you have questions as we go, you can ask us at stockalpha.ai.
Thanks, Jeff. Glad to be here. We'll try to make the numbers feel a little less scary and a bit more useful.
Before we dive in, quick note for listeners. This conversation is for informational purposes only. We won't be giving personalized investment advice or telling anyone to buy or sell specific stocks. Okay, start with inflation. The June consumer price update looked like good news on the surface. Jessica, what's the real story?
On the headline level, it did look like relief. Annual inflation was expected to ease to about 3.8%, and gasoline fell sharply in June, roughly 10%, after a temporary ceasefire reopened a key shipping lane. But that drop is sort of a one-off. Core inflation, which strips out food and energy, has actually been drifting higher for several months, 2.6% in March, 2.8% in April, 2.9% in May. Shelter costs remain the biggest weight in the index, and they're still elevated.
So the headline is softer, but the underlying trend is stickier.
Exactly. And the real question here is whether that headline softness lasts. The ceasefire that lowered gasoline prices collapsed in early July, and oil has already moved back up. So the June number describes a world that, frankly, doesn't exist anymore.
Right.
Which brings us to a second, bigger structural point. AI infrastructure spending is now large enough to show up in inflation dynamics.
Tell me more. How does AI spending become a macro force?
I mean, when you look at the data, hyperscale data center buildouts consume power, land, labor, copper, and capital at a speed that compresses what would normally be a decade of investment into a single cycle. Services inflation stays elevated partly because of AI-driven labor demand. The Fed has flagged AI-related energy needs as an inflationary pressure. That combination keeps the central bank cautious and keeps long-term yields higher than they otherwise might be.
Short reactions.
Right, yes.
So higher yields matter. How do they actually change the winners and losers?
Higher yields are basically a valuation tax on long-duration assets. They hurt companies whose cash flows are far out in the future, and they punish firms that must go back to markets to raise cash. In an environment where the 10-year yield has climbed to about 4.62% and the 2-year touched about 4.28%, financing risk becomes a big differentiator.
Okay, now, you wanted to use a company example to make this concrete.
Yeah, honestly, I was a bit surprised by this one. Poet Technologies is an interesting case because the same macro storm that pressures many small-cap tech names also highlights what Poet has already secured.
Walk me through that. What has Poet done?
Over the past year, the company raised $830 million across multiple equity rounds. And as of June, they reported holding more than $830 million in cash and short-term investments with little debt. For a pre-revenue or early revenue scale technology company, that balance sheet materially reduces financing risk. It funds R&D, their manufacturing build-out in Malaysia, development of light sources, and a planned 10-fold capacity expansion in wafer production and optical engine assembly. The company also says it has room to pursue acquisitions. On the demand side, the commercial picture has hardened. In October, they secured an initial production order for more than $5 million of 800 gigabit optical engines, with shipments targeted for the second half of this year. In May, they announced a supply agreement called LumiLens that's anchored by an initial $50 million purchase order and a broader framework that targets over $500 million in cumulative revenue across 5 years. Those revenues are contingent on development and scale-up milestones, so it's not guaranteed, but it's contractual demand rather than just interest.
Interesting. And they're working on higher speed modules too?
Yes. They and a partner are developing a 1.6 terabit module aimed at AI clusters and hyperscalers, with samples targeted for the third quarter of this year. Industry forecasts point to very large volume ramps. Light counting, for example, forecasts around 125 million units of comparable transceivers shipping from 2027 through 2031. Poet is targeting more than 30,000 optical engine shipments across this year, with much larger capacity by the end of next year.
So they have cash and contracted demand. But what about efficiency? How does Poet's tech tie to that inflation story you mentioned?
If AI-driven energy demand is an inflationary pressure, technologies that reduce power and cost per bit become procurement priorities. Poet's optical interposer approach co-packages lasers, modulators, and detectors on a single substrate. That design aims to simplify manufacturing at scale and reduce power and cost per bit. In a world where hyperscalers face higher power bills and higher capital costs simultaneously, integration and efficiency shift from nice-to-have to must-have.
So what's the concise read for listeners who want the takeaway?
Analysts note three things. Sticky core inflation and large AI-related Capex are keeping yields elevated. Elevated yields punish companies with financing risk and reward companies with strong balance sheets and contracted demand. Poet, in this framework, looks positioned with cash, low debt, and early commercial contracts. That's an observation based on public data, not a buy or sell recommendation.
Yeah, that's a good point.
Quick final takeaways for listeners.
Go ahead.
1. The June headline CPI was helped by temporary gasoline weakness, but core inflation is stickier than it looks. 2. AI-driven infrastructure spending is now large enough to affect inflation, energy demand, and interest rates. 3. Higher yields amplify financing risk. Companies with large cash buffers and contracted demand face fewer of those risks. Analysts say that's why some names stand out in this environment.
Great. If you have questions about anything we discussed today, you can ask us directly at stockalpha.ai. We answer listener questions live. And for more market insights, head over to stockalpha.ai. Jessica, thanks so much for breaking that down.
Thanks, Jeff. Always good to talk through the details.